I just want to reiterate Dan's point about the operating account concept. Ooh, that is such a big one. It's to me that would give me anxiety. If I was to stick real estate in a self-directed IRA, think about it this way. You have a multi-residential unit that you own. Life is good. Assets in the account, in the self-directed IRA. You got a sufficient cash cushion. Things are going along real well. And then all of a sudden you need to replace the roof. Do you have enough cash in the account to do that?
And in addition, can you contribute enough to get the roof done?
And then can you borrow, like, and then to the point about leverage,
you could, you theoretically could borrow from it, do a HELOC, but that might trigger UBIT.
Right.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, as always, Dan Weiss and Nathaniel Leach. And today we are going to be talking about self-directed IRAs. Dan decided to bring this one up to talk a little bit about the intricacies and the nuances to self-directed IRAs and what that looks like. So we're really excited to discuss that topic. But before we get there, as always, if you like what we have to say, please subscribe, like, and share our information and what we do. It really helps support us. And with this podcast, we would really, really appreciate it. So again, please like, subscribe, and share to Critical Thinking Required. With that being said, Dan, how about you drive this ship today and let the crowd know what we're talking about?
I'd be happy to, Tim. So we'll define a self-directed IRA here in a second and then go back and forth talking a little bit about it. It's been around for some time now, but in the last couple of years has become a really popular piece of conversation. And like so many things, then that means that people grab onto it, not fully understanding what they grab onto for a various number of quantitative and qualitative reasons that we wanted to explore a bit further and provide some education on. So a self-directed IRA is a type of individual retirement account, an IRA, that allows investors to hold investments that typically a common thought IRA cannot hold. So hence, again, why this has become so popular the last couple of years. We have people that will want to hold precious metals or Bitcoin, for example, or other crypto can be held in a self-directed IRA. And of course, real estate. And that's really probably the big pusher that we see when it comes to self-directed IRAs. And of course, it is just not quite that simple, but it can be a useful tool. Hence why we're talking about it today. Being an IRA, there are some common pieces that you would expect to see, such as contribution limits that are indeed annually based. So why don't we start there? Would one of you gentlemen like to pick that up, please?
Yeah, Dan, I'm happy to take on the contribution conversation. So the one thing I guess we should kind of throw out there is that you have an IRA or a Roth IRA, and Dan is now talking about a self-directed IRA. So a self-directed IRA is going to act just like an IRA or a Roth IRA, but the self-directed piece is really talking about investments, not necessarily talking about any contribution limits or anything outside of that. So you're going to follow the same structure as a IRA or Roth IRA, which means that your income limitations are going to apply, meaning your deductibility income limitations are going to apply to this specific account. So let's just use a traditional IRA for an example. If you want to make a contribution to that account, you can make up to $6,000 if you are under the age of 50. If you are over the age of 50, you can add $1,000, which means you can contribute up to $7,000 to that account. There are income limitations to the deductibility of that $6,000 or $7,000, right? It's dependent on your income. And so, but if you exceed those limits, then it's going to be non-deductible, but you could still make a contribution. Roth IRA, same thing. There are income limitations to make a Roth IRA contribution, But once you actually get past that, you can't make a contribution. There are some different ways that maybe you could do that, but it's not really part of this podcast today. We can talk about that on a different podcast. But overall, the biggest thing is that contribution limits are going to act exactly like an IRA or a Roth IRA. You're going to pick one, a self-directed Roth IRA or a self-directed IRA. And the self-directed piece, again, is strictly about investments.
Thank you, Tim. Other thing to understand is that it's not everybody offers this kind of structure. So when you look to set up a self-directed IRA, it may be with a specific custodian, right? That is where funds get held, that may focus on alternative concepts like this. You may not find them with a custodian that you're familiar with. You also might, but don't take it for to be the case without actually looking into it. There are a number of entities that do just this specifically. We could talk a little bit about what our experience has been with those custodians. I'll throw it back out here to the crowd of two in a second, but do be aware of who that custodian is, because we have had the experience that with some of them where the fees and the overall experience are not what you perhaps hope for. In some, that's not been the case. Gentlemen?
I'm assuming, I don't think, you want to take this one or do you want me to take this one? It's up to you.
Well, since I really don't have that much to contribute to this conversation, apart from some very specific niches, I do actually have a small opinion on this particular point.
Please.
Read the fine print. That's all I got.
Good.
No,
I mean, you are right. You are right, though. It's like I can expound upon the fine print, but you are 100% correct. You do need to read the fine print. Nathaniel said that succinctly and very well. There are been some custodians out there that will put themselves out as self-directed IRAs, and they're usually not. The fine print is built in some things that maybe are disadvantageous to the investor or the person who's participating to the custodian. There are some definitely self-directed IRA custodians that are just well known, been around for a long time, have a nice structure. Because the thing that you really need to understand about self-directed IRAs is Dan is correct as he started this podcast. A lot of people want to use like real estate, for example, within their IRA. So the reason why TD Ameritrade or larger custodians that typically do bonds, different securities, equities, things like that, don't participate is because you have to be able to assess, you have to have the account value, which there's just a lot more management and a lot more nuance to that specific asset. And so not everybody does this type of work from a custodial perspective. We have had some experiences where, again, somebody did not read the fine print and it was a little bit more on the sketchy side of things. And we had to do some investigation on like, okay, who is this? What are they doing? It turned out that it was kind of just threw a shingle up and like, hey, we're a self-directed IRA custodian. Like it just didn't turn out to be very good on the back end when it really came down to it. It was actually difficult to get out of this type of an investment as well. So when we are recommending custodians, Nathaniel's 100% right. Read the fine print, do your due diligence, and really pay attention to fees. So most people don't recognize that even like TD Ameritrade, Schwab, or Fidelity sometimes will force custodial fees. Our RIAs like ourselves sometimes will cover that type of custodial fee on the behalf of their clients, and it's usually really, really, really small. It's not something that's extremely large. That's not how they typically make a ton of money. But custodial IRAs are going to see a big increase in that. So it might be a new cost to an investor that they're not used to or not used to seeing, because again, it's not that they're just trying to charge you more to charge you more. It's because typically with the investments that you're using in this self-directed IRA just cause more work, which creates more cost. So you have to just be aware of what that cost look like and then compare it across the board with other custodians that, again, are typically well-known, have a track record, and that you can do some due diligence on and ask good questions. Read the fine print.
I think in a case like this, there are people that investors that really do like to dabble with this kind of instrument. This is a situation where you should definitely ask around and get an idea as to what experiences have been with different custodians. We've had experiences through clients with like Equity Trust, Alto, Rocket Dollar. These are players that have been around in this particular with this concept for a longer period of time. And
I do think Rocket Dollar is relatively new. Like they're kind of more on like the fintech kind of newer, but they definitely have a good program. But I think Rocket Dollar is a little bit on the newer side of things.
So the things for people to kind of explore. Like Nathaniel said, read the fine print. I think it was last year, but they kind of blend together. There was a lot of talk about this instrument. I don't think people really realized that they were talking about this instrument in the media. But we had a couple questions that came out of that. There was a story that came out about one of PayPal's founders, Peter Thiel, and his usage of an entity like this. And I think there was a lot of negative connotation to it. I don't know. Regardless of how you may or may not feel, I mean, he was just using the tax law. But Nathaniel, I know you're dying to speak about this. Do you want to perhaps talk a little bit about what that headline was about and some of the details that revolved around it, and how an instrument like this was used to basically do what he was intending to do, and others have done similar concepts, similar usages?
Sure. So I don't remember the exact numbers, but so the article was about Peter Thiel, who was one of the major investors in companies such as PayPal, Facebook, and he had amassed a IRA or qualified assets total of, I think it was $5 billion, I want to
Sounds
say.
about right.
So there was this huge hubbub about this. But as Dan inferred, you can't blame somebody for taking advantage of something like this. The opportunity was there, and he wasn't the only one taking advantage of it. I personally actually read about Jack Dorsey, the co-founder of Twitter, Square, also a part of the PayPal mafia, and he had done the same thing. I read it in, I can't remember where I read it, but I'd read it years before the Peter Thiel story came out. And I was just taken aback at how smart it was. It's genius. And I understand I understand how most people could be disconcerted by these turn of events. But I would also counter by saying that this is available to anyone. You don't have to be some millionaire, billionaire to take advantage of this opportunity. You can, and I would say that because people start small businesses every day. There's over 30 million, I want to say 32 million small businesses in the US alone today. And while some closed their doors during the pandemic, I think that they've actually turned the corner and we're now actually net plus since COVID started for the number of small businesses in the US. There's nothing stopping you from putting a piece of your business inside of a self-directed IRA. Now, I am not saying you should go out and do that tomorrow. I am instead saying do your research, because it might behoove you to do that. There are reasons why it may not, though. If you put something in a self-directed IRA, you have to understand the consequences of doing so. For example, we were going to hit on this later, but I guess we could just tie it in now. There is the UBIT that you have to watch out for, which stands for, somebody correct me if I'm wrong, Unrelated Business Income Tax. Did I get that right? All right. So what that means is if, for example, we have a small business today, it's an LLC taxed as a partnership. So if we wanted to put a portion of this LLC inside of a self-directed IRA, we can do that. However, any income that is generated from our business, let's say the IRA, the self-directed IRA owns 20% of LBW Wealth Management. That piece of ownership is going to be responsible for paying the taxes that it owes for its portion. So the cash to pay those taxes has to come from the self-directed IRA. So that means that the self-directed IRA, in addition to composing of that asset, that piece of ownership of LBW Wealth, the IRA must also contain cash, and it must contain enough cash to pay your share, the entity's share of taxation on an ongoing basis. Now, with Peter Thiel and Jack Dorsey and other people that have taken advantage of this, they have typically taken advantage of it by investing in companies that are structured differently. So using Peter Thiel as an example, Jack Dorsey, he's easier. Jack Dorsey, he put in some shares of Twitter, and these shares were of Twitter in the form of a C corporation. Now, this enabled him to avoid UBIT because the C corporation paid the tax on behalf of the shareholders. And because it wasn't giving out any dividends, at least at the time, I don't even know if Twitter is today, regardless, because he wasn't receiving any additional dividend income from Twitter, he didn't have to pay any taxes because the corporation, the C corporation of Twitter, was paying the taxes on his behalf as a shareholder. Tim?
Thank you, Thany. That was actually a really good explanation of UBIT and overall where Jack Dorsey's at. The one thing that I did want to just, I'm going to re-emphasize is Nathaniel just went through and said, yes, this is access to everybody. But that is the one thing that I absolutely don't like when people say that, because it's not really. In the sense that there's so many cons to this type of strategy that it's very difficult to execute on. And with Jack Dorsey, Peter Thiel, these other individuals that are able to do this, it's kind of like the stars aligning, right? They have a business, they know what's going on, they put into a C Corp, it all makes sense. There's so many things that make sense to be able to do that, to be able to put it in. It's probably not a huge portion at the time, a huge portion of their overall wealth. There's different ways that they don't need to access it. Like, just in general, the strategy could make sense for them. What's really hard is when people that are not in a position that have that kind of controlling stake, it's not a business that's going to IPO or go public. It just may not make sense for a lot of different reasons. So it does start eliminating, even though Nathaniel did say how many small businesses there are out there, it starts eliminating the effectiveness or the usefulness of this type of strategy. So I just want to throw that out there that Nathaniel's 100% right. Yes, do you have access to it? Sure. But there's a lot of check boxes that need to be checked to be able to whittle it down to say, does this make sense for you? Or does this make sense for your situation? Does this make sense for your family? Does this make sense for your business? In a lot of different aspects and ways. So I just wanted just to emphasize that, because I think people get really hyped up with articles or headlines and, oh my gosh, Jack Dorsey saved all this money because he put into a Roth. And then we get questions of, I want to do that. And it's like, well, you're just not in a situation where the strategy makes sense. But it's not that you can't, it's just, I would probably highly recommend that you don't, for X and Y reasons, which we would have to know that for the client in the situation, but it's something that always should be explored or could be explored. But I don't want people to get hyped up and think they're like, oh yeah, I can definitely do this. There's definitely some consequences that come with it as well. So that's the thing. You can go back. I just wanted to emphasize.
Thanks, Tim. I completely agree with everything that Tim said. To use a metaphor, maybe this doesn't apply to everybody, it would apply to me. I grew up next to a neighbor who had a pool in their backyard. And in those summers when it was nice and hot, I would enviously look over the fence, and you could see through the fence. It's one of those metal, right? And you could see through, and you could see the neighbor and their family had their grandkids over, and they were playing around in that pool, and it looked so good, so cool, like in cool and body temperature, right? And then I would start to think about, do I really want a pool? Because then I got to clean the pool. I got to like check the chlorine levels. I got to make sure that it's not too acidic or too much base. I got to make sure nobody trips and falls in the pool. There's some liability concerns. And then you got to clean out the leaves and all that stuff. Did I really want to do that? The answer is no. So as Tim said, you have to look at the situation as it pertains to your circumstances. You don't want to fit a square peg in a round hole. I don't know how much more simpler I can make it. Square peg, round hole. Don't try and put the two together.
So for Nathaniel, it's best to have a friend with a pool. Yeah. There's a lot of details to know here, right? In UBIT is a really big one that people just don't think about. And it's a conversation we've had a number of times over, especially as it relates to, which is interesting, just people wanting to get into real estate particularly. That's where you see a lot of this, and doing so using like forms of leverage. And that can be a triggering issue when it comes to UBIT that people just don't expect to see, but it's an automatic trigger from what we have seen. So that's one huge detail that often gets missed. There are some other things to think about as well. Nathaniel hit on some of this, but I'm going to go a little bit harder onto it, and then I'm going to throw a couple other things out here for the gang to talk about. But if you picked up or not on it, you kind of got to see this as an operating account for the entity that it's tied to, right? So if you buy a property, and a lot of times people want to use this because they have significant assets in an IRA to be able to do this and buy a whole property. Great. But understand then that the proceeds of that property go into this account. Understand that this account has to support that property like an operating account. So you have to keep that in mind, that if, depending on the size of this too, I mean, you might have to be making contributions just to fund it for a period of time to keep it going. You also have to keep in mind, and I see Nathaniel's got his hand up, so I'll pause here in a second too, that again, we said this is a form of IRA. So we talked about the contributions, but you also have to consider too that there will be RMDs on this account as well. So at some point in time, you do have to consider that some funds are going to be forced out for that particular reason. That too, because you can have this as a qualified account in a lot of different forms. So we've seen this in a 401k form too, often misunderstood, right? We've had people that say, well, it's active, therefore I don't have to take that distribution. That's not the case. Depends on your ownership of that. If you are more than correct me if I'm wrong, Tim or Nathaniel, a 5% owner of that entity, then you have to take those distributions. So
I just want to reiterate Dan's point about the operating account concept. Ooh, that is such a big one. It's to me, that would give me anxiety. If I was to stick real estate in a self-directed IRA, think about it this way. You have a multi-residential unit that you own. Life is good. Assets in the account, in the self-directed IRA. You got a sufficient cash cushion. Things are going along real well. And then all of a sudden you need to replace the roof. Do you have enough cash in the account to do that?
And in addition, can you contribute enough to get the roof done?
And then can you borrow, like, and then to the point about leverage,
you theoretically could borrow from it, do a HELOC, but that might trigger UBIT.
Right. You also have to keep in mind too, right? Because we see this often again in real estate more than anything else, that when you make that purchase, because this has been something we've seen too that has had some confusion. If you use the self-directed IRA to buy real estate, that entity, that business, that that building that you buy, that has to be strictly for investment purposes. It can't be something that you or family members live in. No, no, no. That's not going to fly. It's got to be strictly investments. The two other things that come off the top of my head for the group to kind of touch on, one of which is concentration. So if I knew he would jump on this. So if any of y'all listen to us fairly regularly, this is something that comes up quite a bit. We three are not afraid of concentration, but knowing that, it's really important to still address it, because most people think they're okay with concentration, but they really aren't. And so again, if you're buying a property, it might become the entire IRA. So that is a major position to think about, because what will often happen is people will have that IRA established if they're going to buy a whole property, which means they sell out of a lot of diversified positions, maybe good or bad, to buy one or two. So you have to understand the relationship to concentration. I figured Nathaniel would want to add to some of that. And so Nathaniel, anything else you want to say about that?
Thank you, Dan. You actually you hit the nail on the head on that one. But I just like to use an example, if I may, to maybe really pound that home about concentration. So I'm not really in these meetings, but Dan and Tim are the ones who are commonly speaking to clients about, hey, how do you feel about concentration? Having that conversation. From what I've heard, when presented with different methods that their portfolio can be invested, when they're shown how concentrated the S&P 500 index is, or how concentrated an actively managed portfolio is, you get various degrees of reactions. From the S&P 500, where Apple is, I don't know, what is it, 8%, 8% now of the total, right?
Yep.
And then you get some of our actively managed portfolios, which could be much more than that, let's say. And then you show them this, and then sometimes the reactions when if the concentration of a particular security goes above 10, 15%, you can see that some people start to get a little anxious. But then that same person, if you were to tell them, hey, you take this exact same amount of money and you can go buy that investment real estate that you want to go buy, a lot of them will say, oh, okay, that's a great idea. Not that we ever do that, to be clear. We never say that. But they'll come to us typically and they'll say, hey, I want to take this much money and I want to invest it in investment real estate. And then we would then probably say, okay, but didn't you just say a month ago that you didn't feel comfortable with that amount of concentration in that account? Isn't that the same thing? Back to you, Dan.
Thanks, Nathaniel.
I think that the behavioral side of that with real estate specifically, you can see it. It's a physical asset you can touch, see, and feel, and you know it, which makes it
feel like you can control it.
Yes, and it's a different. I think Nathaniel hits it on, also nails it on the head in the sense of it's a behavioral bias from the standpoint of you don't really understand what you own when you buy Apple. Like we get the question all the time. What is a stock market? What do you mean I buy equity? What does that mean? What do I actually own? It seems very fictitious, especially with the increase in technology and different things. So like overall, it's a lot harder to mentally comprehend relative to like, I see that real estate, I know it's there, I physically can touch it, I own it. It doesn't show me like on the face what it's trading for, what the price is worth. I mean, with Zillow and Zestimates, maybe that's becoming a little bit more transparent than it has in the past, but it's still not nearly minute to minute, second to second prices of what you're actually worth. So there's the behavioral side of that, the difference of why people see concentration one way or not the other.
I'll toss out one more thing unless anybody else wants any other details to come out there. I'm glad you added that though, Tim, because everything we talk about is very behavioral based, right? And to be straight up, I think, we've talked about this. I don't know that we fully know the answer to how this really plays out, but a year ago this month, we had the Secure Act came out and it changed how beneficiaries can receive qualified assets, including in a self-directed IRA. So again, it's an IRA. So now with the IRA, you have to get rid or dispose of those assets within a 10-year period of time. We were talking amongst ourselves, and we're not quite exactly sure how this could play out. It could play out in different forms, but it is something to consider, right? If the IRA owns that property and you inherit that property, the IRA has to be drained within a 10-year period of time. Now, that may not be an issue. You could sell the property, and that would, of course, then bring proceeds into the account where you can then dissolve of. But it might be different if you want to keep the property. Tim and I have talked a good amount about this, so I'll let him jump in here a second, because you may be in a situation then, I would think probably very likely, that you don't have that option if it's in a self-directed IRA, because once you run out of the operating account, I don't know how you keep the property in play. But Tim, we've talked about this. Hop on in.
All right. I rose my hand and everything. Okay. So, I mean, overall, if you're looking at, to kind of give people the understanding, right, is we're talking a lot about the operating account, what has to come out of it. So RMDs, required minimum distributions, would be forced on a traditional self-directed IRA. They would not be forced, okay, for somebody who's living on a self-directed Roth IRA. Now, as Dan mentioned, we're really moving over into the self-directed inherited IRA, which means that now their spouse, somebody else has taken it on. Now, it depends on who's inheriting it. If it's a spouse, they can assume it as their own IRA. No issues there right now. But let's say that it goes to the kids for simplicity purposes, which means now that these kids have to own this IRA, or let's just say it's one kid, single child, goes to the child, no parents left, they now own it. If it's irregardless if it's a traditional IRA or Roth IRA, the child will have to dispose of all of that or get it out of the account within a 10-year period. Now, the question is let's say that you want to take, income distributions from it because you need the money as a child, and you start taking the cash out of the account from operating purposes. Like Nathaniel mentioned, what happens when the roof needs to be done? Well, it's got to come out of the account, right? You got to use the account still. And then let's say you get to the 10-year period and you still own this property. Most likely you would have to sell the property. Now, we'd have to do some due diligence on if you could move the property outside of the IRA and still potentially own it, but then see it as a distribution from the IRA to kind of get it down, which then it's in just a normal like titling of your name. Or do you actually have to sell said property, like truly dispose of it? I think the biggest question is that if you're going to use it for estate tax, or like if you're going to use it for the tax deferral, which can make sense, and that, we check all the boxes. The question is that, do you want this property to be inherited by your children? If that answer is absolutely yes, then you have to really start thinking about, okay, well, when do I put the money? Like, when do I put it in? How long do I get the tax deferred growth? What does it look like when I give it up? Because as of the state, the tax code works today, you can get what's called a step up in tax basis, which means that if you say, hey, you know what, I want my child to receive this physical asset, but I don't care if they keep it or not. And let's say the kid raises their hand and says, I don't want to keep this. I don't want to deal with what mom and dad did. Then it could make sense to not put it in there and just allow it to be outside of it. Yes, you may still have to pay operating and income taxes, but then at the date of the death of the parents, the child would be able to get a step up in basis and pay no taxable gains on said asset. So depending on how much it's valued, what the cost basis is, there's a lot of different attributes that you'd have to look at. But overall, it causes something for, if someone were to come to us, I guess the way I could simplify it is we would raise our hands and be like, hold up, wait a second. Like Nathaniel said, pools analogy, what's the pH level on the chlorine? What's like, do we need to clean the leaves? Do we have a cover for it? Do we have liability insurance in order that kids don't die and fall and we get screwed? Like, all of that stuff needs to really be ironed out and truly taken a look at. And then also ask the question of, do you actually just want to own the pool? Like, that's question number one. Do you actually just want to own it? And then if you say absolutely, like Dan would probably say to us, yes, I want the pool. I will use a pool. I love the pool. And I even want to put something over it so I can use it year round. Great. But let's explore what that all really truly means, the upkeep, the maintenance, and all of that stuff, to make sure that it makes sense from a strategic perspective across the board. So it can create a lot of hassle. It can create a lot of benefit. It can create a lot of benefit, can create a lot of hassle. You have to do the cost benefit analysis if it makes sense or not. And then what your overall strategic goal is for the family and for the inherited asset and what that could potentially create. So you'd also have to, the custodian's still involved, so there's costs. Like, it's just not that simple. It's just not that easy to say, yeah, this makes a ton of sense. It needs to be explored and uncovered.
As we close, Tim said earlier, does it make sense for you? Does it not? It makes sense for some people. For some people, it doesn't. It just totally depends on all the factors we've talked about today. And as Nathaniel mentioned, just read the fine print. It's really a good place to start and see if it makes sense. Again, there are pros to using this instrument. There are also cons. Make sure it's the right fit. Daniel?
I'm just really going to hammer this home. Read the fine print. It's not that hard, really. It's a nice thing to read before you go to sleep. It'll actually probably knock you out to go to sleep. And then you'll go to sleep thinking about it, and then you'll probably retain more of it. Read the fine print, folks. It really, because you're protecting yourself. Read the fine print about the custodian. Read the fine print about whether a self-directed IRA makes sense or not. Read the fine print on the fees. Read the fine print. I wish I got my fingers right when I said, here we go. Read the fine print. 4. Concentration. Think about it. But as Tim astutely put out, be aware of how much concentration if you want to invest in real estate, how much concentration is your portfolio taking up of investment real estate? And then think about, would you be comfortable if your money was invested in a singly publicly traded security at that same concentration? If the answer is no, should you be doing that much in investment real estate? Probably should ask yourself that. Also be aware of unrelated business income tax, UBIT. You will have to pay taxes depending on how the entity within the self-directed IRA is structured. So make sure you have enough cash in the account to do so. And then above all, do your own research. This is different from reading the fine print. Do your own research. Understand what a self-directed IRA is. Don't immediately discount it. But then again, don't immediately think it's the right thing for you. Do your research. Don't just read the sensationalist headlines about Peter Thiel's $5 billion and then automatically put it down to, oh, he's a billionaire. No wonder he could do this. Anybody can do it. But just because anybody can do it doesn't mean it's the right thing for you. Tim?
I guess the best way that I'd close with is that self-directed IRAs makes my spidey sense go off. Where it's just like, okay, cool, that's a good idea. Let's explore it. And the funny thing is I'm going to be just very honest, right? When I did the CPWA is driven around higher net worth individuals, and its strategies from a planning perspective, both from an estate plan, business perspective, closely held businesses, all that stuff. And the one thing that I really learned, right, what I really learned about that is that people who take advantage of said strategies, like Nathaniel was mentioning, the people who seem to have higher net worths, big net worths, they do it for a reason because they have the ability and opportunity and are positioned to do it. Unfortunately, for the vast majority of the United States, these strategies can happen, but don't make sense or don't work for their situation because of how they're positioned. So when people come to us and say, well, my friend has a self-directed IRA, my uncle has a self-directed IRA, my parents have a self-directed IRA, again, my spidey senses go off because why do they have it? What do they put in it? Do they know what they're doing there? Do you know why they're doing it? So just because everyone else may be doing it, no one's asking the questions of why are they doing it? What are the underlying reasoning behind it? Can we unveil that and see? Because their situation just may be completely different. And so that's why I say my spidey sense goes off, because it sounds really cool. It's sensationalized in a lot of different ways. But there's a lot of work, there's a lot of preparation, there's a lot of positioning to make the strategy work over time. It's just not that simple. I wish it was, because if it was that simple, we'd be doing it for everybody. No questions asked, but it's just not that simple, and it takes a lot of work to do it right.
Well said, both of you. Thank you very much. And thank you, audience, for tuning in and hearing us talk about all the subjects that we do. We hope that it was helpful as always, and we wish you a great night. Until next time, take care of yourselves.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,